Look around you. Everything you touch, every app you open, every light switch you flip is making someone else incredibly wealthy. Most people spend their entire life as economic ghosts. They fuel the machine, they pay the bill, but they never actually touch the engine. Welcome to TradingBits X. This channel is all about decoding the economy from the ground up. No noise, just signal. What if I told you there are a 400-year-old backdoor to the global economy? A system designed to let you stop being a consumer and start being a master. It's not a secret, yet 90% of people treat it like a casino because they don't understand the one word that changed everything: equity. Today at TradingBits X, we aren't just talking about buying low and selling high. That's for gamblers. We're pulling back the curtains on what it actually means to own a piece of the world's most powerful machine. We're explaining the stocks, but not the way your bank does it. We're showing you how to claim your seat at the table. What is a stock? Let's start at the foundation. A stock or a share is quite literally a piece of a business. If a company is a pizza, the stock is a slice. But here's the part where most people miss. The size of your slice determines your equity. When you buy a share of a giant like Apple or Microsoft, you aren't just betting on a price. You're becoming partial owner. You own a tiny piece of their patents, their building, their brand, and most important, their future earnings. Think about it. Every time someone buys an iPhone, a tiny fraction of that profits technically belongs to the shareholders. If you could own 10% of any company in the world and you couldn't sell it for 10 years, which company would you choose and why? Drop your answers in the comment below. I'll be replying to the most interesting ones. Dividend, the ultimate passive income. Now, how do you actually get paid? Method number one, dividends. Imagine you own a lemonade stand. At the end of the month, after paying for your lemons and sugar, you have $100 left. You can either use the money to buy a second stand or you can put the money back in your pocket. A dividend is when a mature, profitable company decides to put that money in your pocket. For example, if you own 100 shares of a company and they pay $2 annual dividend per share, that's $200 a year deposited into your account just for holding stock. But be careful, not all companies pay dividend. High growth tech companies like Amazon famously didn't pay dividend for decades. Why? Because they believe they could grow your wealth faster by reinventing every penny back into the business. This brings us to a big debate in the financial world. Are you a team dividend, looking for what a steady monthly or heavily or quarterly check, or you a team growth, waiting for the big score years down the line? Type dividend or growth in the comment. Let's see where the TradingBits X community stands. Growth, potential, and capital gains. Method number two for making money. Capital gain. This is the buy low, sell high strategy. Let's look at the data. If you bought a stock at $50 because you believe the company has a great product and 5 years later that same company has tripled itself, the market will likely price that stock at $150 more. That $100 increases in your profit. The beauty of stock is that unlike a fixed saving account at a bank, there is technically no ceiling on how high the stock can go. When a company innovates, the shareholders win. Think of it like a car. A standard car loses value the moment you drive it off the lot. But a great stock is like a car that gets faster, more efficient, and more valuable every single year you own it. Has anyone ever get caught on a 10 bagger? That is an investor speak for a stock that went up 10 times what you pay. If you have, tell us in the story in the comments below. The reality of risk, managed and markets. We have to be real. The stocks aren't a guaranteed escalator to the top. They are a roller coaster. When you own a business, you own the bad times too. Bad management, a global recession, or a new competitor can send stock prices tumble. This is what we call volatility. The secret to surviving the stock market isn't avoiding the risk, it's managing. This is why we diversify. We don't put all our eggs in one basket. We buy different sectors, different countries, and different types of companies. If your portfolio dropped 20% tomorrow, would you panic and sell, or would you see it as sell and buy more? Be honest, your mindset is your biggest asset in trading. The stocks are the engine of wealth. They allow you to participate in the greatest idea of the human race. But they are only one half of the story. To build a truly bulletproof portfolio, you need to understand the other side of the coin. What happens when you don't want to own a company, but you want to act like the bank? What happens when you want a guaranteed return instead of a maybe? That is the world of bonds. In our next video, we're gonna dive into the bond explain. We'll talk about sovereignty risk, how inflation eats your return, and why the relationship between the stocks and the bonds is the most important thing you ever learn about asset allocation. If you find value in this breakdown, please share this video with one friend who is always starting their investing journey. Let's grow the TradingBits X community together. And remember, money, markets, we're trading the future. See you in the next one.